So I'm going to give you a little bonus here at the beginning, an unplanned bonus with a live chart from today. And I'm going to throw that up there, and I appreciate Amar giving me the go-ahead. So I do combine Amar's research, and it was, like I said, it was completely by accident at one of these events. I believe it's been a while ago. I've been lucky enough and fortunate enough for Reed to have me on a couple of times. So here's the power zones in TradeStation, and here's what I'm going to be showing today is how I trade the market tops and bottoms in order to catch. Like today, at the end of the day, we had a signal that was in confluence with the power zones and called the market top for this afternoon's rally. And you can see this is the Dow on the 5-minute chart. I'm going to be talking about why this structure is important today, but I did want to, while it was fresh in your mind, let you look at, his research applied in a real market. And now this is not, it's not enough to retire on, but if you're patient enough and you can get the confluence of multiple speakers or multiple ideas, you can catch a very low risk, which is what we're all about. Low risk, nice little, this is actually about a 40-point move in the market almost, a 30, 35, 36-point move in the market, which is good enough in the Dow for 150, 175 bucks right at the end of the day per contract. So you can see where that can add up. So his zones are definitely valid. I do recommend him, and just as a full disclaimer, Amar and I have never met. Other than being co-presenters here, I was fortunate enough to look his research up, and it intrigued me the way that they do their clusters and things, and I applied it to my trading even, and because I'm always looking for an additional edge in the market. So that's an example of how his zones and my research or my techniques, my rules for entry can be combined for some pretty profitable trades. And if we have time, I will be more than happy to show you guys some other examples in different markets of what the reversal patterns that I'm going to show you to spot tops and bottoms, combined with some other techniques and other people's research, because that's what today's talk is about. It's not about me having the ultimate trading system. It's not about me having the golden egg or the holy grail, if you will. It's about trading low risk tops and bottoms. So let's go ahead and get into that. And I thought I hit the button. There we go. And talk about trading those tops and bottoms in market structure. So we can kind of get to what we have here and get you guys some good information that you can apply. If you trade tonight or if you're trading tomorrow, we want you to be able to apply this information immediately. First of all, and now that I've shown you, the little bonus section, it's time to get into the legal parts of it. I'm not going to spend a lot of time on this. This is just a standard risk disclosure. Basically, the main thing is this blue text in the bottom, the CFTC rule for 4.41. The trades that I'm showing, some of them will be, or a lot of them will be hypothetical or simulated performance. I have taken some of my real trading accounts, so that goes ahead and answers the question, do I trade in real life? Yes, I do. And I actually, me and my trading partner, trade that we call out the trades live. So that's something that you may be interested in, some help or help, kind of honing your techniques. Read talked a lot about psychology. I am a huge believer in psychology. Talking about your mindset and your mental approach a little bit as well. And as far as be successful in this business, I want to tell you that pretty much anybody who admit and is willing to fail a lot can be successful in this business. And that's going to sound crazy because a lot of people don't want to fail, but and there's many people that talked about failure as their first step to success. The light bulb comes to mind, Einstein and all of those guys. There's a whole lot of history involved in people who fail being successful. Michael Jordan, if you're a sports fan, he talked about how many game winners he missed in order to make a few of those game winners in the playoffs. So don't be afraid to fail. Don't be afraid to try new things. And don't be afraid because of your background to try this as a profession. I was born in a very small town, and I've been able to come back home for the last, going on, I moved back home, I believe it was 2002, so about 13 years I've been back in my hometown, which that's where we wanted to raise our kids, my wife and I. I did graduate from ODU, but I did not graduate with a finance degree. I actually graduated with an information systems degree and spent the first part of my professional life in corporate America, and I got tired of the quote-unquote corporate ladder climbing and the the ceilings that you can get in middle management and IT management. So I did take on trading about 10 years ago now, and after about 3 years where I could get some consistency, I did co-found TradeTheSystem.com, and since then I've been moderating a trading room live for the last 7 to, actually it's about 8 years now, to just to hone my skills and to meet people like you've had here on the panel. So I've come into contact with a lot of different people, and I've adapted my trading style as I find more of an edge. I'm not afraid to try new things and to see if it helps my performance or not. So let's get into the first. When the why is big enough, the how is easy. For those of you who have heard me speak before, this is the exact same slide that I love to start with, because a lot of people overlook figuring out what you're going after. For me, it was real easy. I told you I wanted to do a family, and this is the family and it's why I trade. It's so that I can spend time with these two little ones right here. And for full disclosure, you guys gave me a little time here to begin with, and I tried to throw you a little bonus of a little look into my trading methodology, and I'm going to explain it. But for full disclosure, you're not going to get overtime from me today, so I will be very cognizant of my end time today, because this one right here, my oldest son, has a baseball game tonight, so I will be leaving here and going straight to the baseball field. I've got to brag on him for about 5 seconds. His team is undefeated, and he will be pitching again tonight. So right now we're 10-0, and we have 6 games left, and we're playing the team. If we beat the team tonight, we clinch first place for this. So my priorities are, and I don't make any apologies for it. I love trading. I love the profession, but my family comes first. So I gave you some pre-game bonuses. I won't be giving a whole lot of after-game bonuses today, and I hope you guys understand that. So I am very fortunate. Thank you guys. I do consider it a perfect family. I'm fortunate to have them and be able to support them through this thing we call trading. But the rewards are there if you're willing to put in the hard work. Now, so I can make sure I make that baseball game, and let's give you the information we're going to be armed with to help your trading starting immediately. Starting tomorrow, you can look for these patterns. We're going to talk about planning your trade. Now, I'm going to go through this real quick because there are a lot of trading plans out there. I think the simpler the better. I think the focused you can be on, 1 or 2 or 3 to 5 things, the better off you're going to be and successful you're going to be. So we've got a 3-step trading method, and it's real easy to remember. TTS for trade the system. The T stands for trend. The second T stands for trigger, and the last S stands for supervising the trade. If you can remember those 3 things, you can tackle any market. And when I say any market, I don't care if it's the Forex market. I've got a 30-year veteran that co-hosts with me in the trading room that he specializes in the grains, corn, soybeans, and wheat. Occasionally he'll start talking about live cattle. But all of that, the Forex, the index futures, gold, crude oil, all of our methodologies center around these 3 components. The first thing we need to do is identify the trend, which way is the market going, or if it's sideways. Then we've got to get a trigger, and this is where, like I said, you can take my stuff, my methodology, if you will, or my specific rules, and apply them with some of the other speakers, research, like Amar's research. If you've got a zone that you're looking at for today, if you've got some kind of calculations that you do that are proprietary to your trading, you can look for some of these triggers, and that's what I'm going to focus on tonight. I'm not going to focus a lot on defining the trend. I think a lot of people do a very good job of defining the trend. I think a lot of people do a very poor job of entering the markets, especially the futures markets. I think that a lot of people take unwarranted risk, and I think they are not trading the proper time frames for their risk tolerance. And so that gets a little bit into the psychology and money management as well. But we're going to talk about how you can make those triggers and define your risk to decide if you want to take the trade. We'll talk about that in a very short amount of time. The supervision of the trade, that is one that it would take a whole nother webinar, so I won't be touching on that. We're going to be focusing a lot on number 2 here today. But this plan is not the most important thing. The most important thing is just have a plan. I don't care if you use Trade the Systems plan. That is irrelevant. If you find a better plan out there, if you find somebody, a better mentor out there, be my guest. But just have a plan and have some kind of criteria that you go through before you hit the button to make a trade. And I don't care if it's a day trade or if it's a swing trade. So just real quick, how many of you are stock traders? Well, just list the 3 categories for me. List if you trade stocks, options, or futures, or all of the above, or Forex. So yeah, I'll throw the 4th category in there. I don't do a lot of Forex trading. I will trade currency futures. So little different animal, but it's still trading, you know, the currencies. Okay, Forex, stocks. Okay, well, we've got a really, really good binary options. That's there you go. Okay, so I will have to be honest with you. I have dabbled in the binary options, and I have some friends of mine that are actually so-called specializing in binary options. The jury is still out on that for me. I'm not completely comfortable with the binary options, but I do know that that is one of the emerging markets, if you will, and it is something that we're looking into. But I'm a really big proponent of, if it's not broke, don't fix it. But I do know the importance of adapting. So my trading's not broken yet, so I'm continuing to do what's worked. And the one market that I will tell you I'm not going to be able to talk about is binary options yet. But the others I can talk about, because even if you're doing equities and you have a plan, there are a lot of good strategies out there. So I don't care whether you're an equities trader or an options trader. Have a clear-cut plan to your trades, and there can be different plans. My day trading, when I'm day trading the futures market, it's a completely different plan than when I take equity swing trades or options trades. Okay, so let's talk about day trading, and let's talk about day trading the futures, whether it's currency futures. The structure that I'm talking about does apply to Forex. What I'm going to tell you about the Forex markets is I would not get too minuscule on a time frame. I would, stick to your 2 and 4 hour time frames at minimum. They're going to be your better performing trades. When you start getting down, in the Forex market, since it's the volume is based around a lot of the exchange opens and things like that, you can get sucked into some, I call it whippy markets in the Forex. But any of the markets that you use, I'm going to show you a method that's going to identify potential tops and bottoms. And the key here is it's not going to call every top and bottom, but it is going to show you a low risk area of entry. Okay, and that's what I want to focus on today, is getting you versed enough to look at any chart, whether it's the Dow, the S&P, crude oil, the Japanese yen, whatever you're trading, or Apple, and being able to look at the chart and define your risk. So we're going to start real quick with market structure. Everybody should know, if you've been trading more than probably 3 weeks, that this is a candlestick chart. Okay, now these candles represent a lot of information for you. Obviously, you've got the red candle that says it's going down, the green candle says it's going up, but these little tails and wicks and highs and lows have a lot of hidden information. And we're going to start with structure. So when I talk about pivot points, I'm not talking about what Amar's talking about as far as calculated pivots. I'm talking about price pivots, okay? And they're 2 different things. There's no calculation needed. When you see a red candle and a green candle, you know you've got a pivot point. Okay? Now, it can be a confirmed pivot or an unconfirmed pivot, and that's more of an advanced class that you can learn, you know, nuances about how you determine your validity of each pivot. But what I'm concerned with is when you see a pivot and the market kind of goes sideways or retraces a little bit, and then you see another pivot, I'm concerned about the reaction of the market and whether they are piling on or whether they are running out of gas. And that's how we're going to spot new highs and lows or potential highs and lows, because one pivot point by itself, I can't tell you anything. I don't have enough information. Okay, so if I jumped in a chart and it's going absolutely dead sideways for 3 hours and all of a sudden you get a pivot, that's not information to me. So the first thing you got to have is a move. Okay, no image. You guys don't have an image? You may have to log out and log back in. Sometimes it depends on if you've opened up something. So Andre, okay, everybody else has a good image. So you may need to log out and log back in, Andre. Everybody else is telling me the image is fine. Okay. So we've got the candles here, and what I'm going to compare is how the market's reacting at this swing point versus how the market's going to act at this, what I call a swing point or pivot point. And like I said, I'm talking about price pivots. Okay. So what I'm looking for, and this is a real chart of the Dow in the 2-minute form, you can see that right here we have a pivot point. Right here we have a pivot point, and those market points, right here's a pivot point. Because we have a move, I'm ignoring all of the noise in the other parts of it, okay? So I'm looking and trying to compare, is this low better than this low? You know, what decisions are the markets making? And these pivots are extremely important. If you don't believe me, look at this chart. Just take a second to dissect this chart right here and take a look. There was a decision made right here by the market. There was a decision made right here by the market. The correlation between this low and this low, the way that the market was doing, it left you clues as to, hey, we could bounce right here or we could roll over right here. So when you talk about the importance of pivots, even after they're done or you think they're done for the day, you're going to see the market come back and retest this. Okay? So don't forget about, when you see one of these places that I'm going to talk about, if it's represented as a high or a low, a market top or a market bottom, don't forget about that level, especially during that day. And if you're looking at higher time frames than 2 minutes, if you're looking at like 1 hour charts, don't forget those for about 2 to 3 days, because they're going to show back up. The market loves to come back and retest. You can see how we made a move here, came back up, and right where we previously held, once it broke, and I use a lot of terms that you probably heard, once resistance or support is broken, like once support is broken, it becomes resistance, and that is never more true. Every day I go and back test a lot of charts and look at charts a lot, and it never ceases to amaze me, the age-old sayings about support and resistance. It always shows itself. Okay, so we're going to talk about how to take advantage of these price pivots and what they mean and the relationship between the two. In order to do that, I'm not going to bore you with a test after this on you know what the actual definition of an oscillator is. Basically, what I want you to know is you use oscillators whether you know they're called oscillators or not. If you've ever used the CCI, the MACD, the price channel, the RSI, or the stochastic, or there's you know probably 40 or 50 different others out there that you can use to determine how is the market progressing in a better fashion? Is it getting stronger, or is it getting weaker with the new highs and lows? Okay, so what we're going to do is we're going to take these oscillators and we're going to compare them to market structure. And like I said, I don't want you to try to get all of these, you know, today. I don't want you to try to open your charts and put all of these on there tomorrow. I want you to take time and look at each one of these and figure out which ones you like the best and you understand the best, because some people, if you're a longer term trader, are going to like RSI. That's a little slower indicator than this price channel indicator. You can see how the price channel is a little quicker. That's good and bad. That's good for some people, but it's bad for others, okay? So I don't want you to try to boil the ocean. I want you to take what I'm showing you and over the next couple of days apply it with different indicators. The exact same structure that we're going to look at can be used across all of these indicators, okay? And it will be a gauge as to whether the market is gaining strength or losing strength. So let's break this down a little bit and talk about the key to calling market tops and bottoms, and it's divergence, okay? And a picture's worth 1,000 words, so I'm going to shift to the picture and tell you what divergence is. For those of you who have never seen divergence, there are two types. There's regular divergence and hidden divergence. I will not touch base on hidden divergence. That is a powerful technique, but we've only got 45 minutes here, so I'm going to focus only on regular divergence today. And like I said, if you want to know more about hidden divergence, I definitely can help you out there. So we're going to talk about regular divergence. It's where this is a price chart, okay? And price is making a new high. You can see I told you you need a move in order for the structure, the price pivots, to become usable or, you know, comparable. And so you have a move up here, a move down, and a move back up to new highs. So that is a move in the stock market. While the price is moving, your indicator is going to be moving as well. It's going to be computing every bar, you know, tick by tick. It's going to be giving you new values. So what the indicator is going to do if divergence is present is it's going to be making highs with price. Every time price makes a new high, the indicator is going to make a new high until you get to a potential top or bottom. And when you get to a potential top or bottom, that's when this indicator is going to give you a heads up as to, hey, this top that we took out in price, it's losing a little bit of its momentum. And it will, in the divergence arena, it's always giving you a heads up before price is actually weakening, okay? So same way if you've got a down move. If you've got a new low in price, then you're going to get a higher low in the indicator. As you're making new lows, the indicator is going to get weaker and weaker, price is going to get weaker and weaker, and then all of a sudden, the next move down is not going to give you weakness in the indicator. These are very, very powerful patterns. So let's take a look at some of them and break it down step by step. So the first thing you got to have is a move, right? Does everybody see the candlesticks? And you can hide this. I don't care what price chart this is. I don't care if it's index futures or Forex, you know, or currency futures or agricultural futures. It doesn't really matter. Or stocks or bonds or options. You know, I mean, obviously you're trading the options on the underlying stock, so this is going to look like a regular stock chart. So the price is making highs, highs, and highs. Well, what do we have present right here? We've got a price pivot and another price pivot. We've got a price pivot right here. So we want to compare. Step one is we've got to have a move, okay? Step two is we need an oscillator down here to help us gauge each one of these price levels, right? You've got to have, you've got to be able to say, oh, well, here's a price level, oh, here's a price level, and we've got to have something to compare it to. So step two is making sure you have an oscillator. In this case, I'm looking at a price channel, okay? And I'm looking at the price channel in relation to the market making new highs. And you can see the market's making new highs, equal highs, you know, and up. We've got a little heads up right here, don't we? Now we've got a very clear heads up right here. And this is, some of this precursor stuff is part of the hidden divergence that I can tell you about at a later date as well. But this particular top was signaled by divergence. And this is a real life example here. So we're at a key level, in this case, the 100% daily ATR, and I'll talk, I've got some additional information on that as well. But this is a place that, if you look like a power zone that Amar talked about, this would be a power zone. This would be one of the confluence zones. This would be my 100 ATR, 100% of the ATR level, okay? And when we get up here, you get to comparing the highs, and all of a sudden the indicator's not making new highs. that is divergence, and that is where this particular high, as soon as this red candle closes, you see the red dot, as soon as the red candle closes, you know that price should not, if this is a true top, should not take out the high of the day. Okay? So let's look at that and zoom in a little bit and look at it with a stochastic. And this is on the Russell chart. You've got a move. You're making higher highs. You get a pivot point. You get another pivot point. You get a lower close, and on the indicator, you get weakness. You can see that weakness right there. The indicator's not gaining strength. The market put a little selling tail up here on this candle. Okay? So you've got a higher high in price and a lower high on the indicator. If you guys are not looking at these price patterns, if you're not looking for these intraday, you're missing out on a lot of low-risk opportunities. Now, risk it appears to be big risk, but remember, we're on an intraday chart, and we have our anchors that can help us out. But we're looking at about a point to a point and a half, and only about 100 to 150 bucks risk on a contract in the Russell. So say low risk. I didn't say no risk, but it's manageable, especially when you're looking at a move from 1,085 down to 1,082, to the risk that you would have had to take. So if you can fill your trading portfolio with 2x the amount of risk, the reward to risk, then you're going to set you're going. How many people right now would take a trade if I told you, well, you're risking $600 and the most you're going to make is $100? You don't really like that. I mean, you've got to be right 99% of the time in order to make that trade setup work. But if I told you that, hey, these trades you could take $200 risk and possibly sometimes catch $500 to $700, a lot of you would raise your hand and say, yeah, sign me up for that one, right? Because you don't have to be right every time. And we all know how hard it is to be right in the markets. You can't be right every time. And this way, you manage your risk, and you're spotting these low-risk opportunities, and you're making the most out of your trades there. And that's what, in my opinion, that's the most important thing in trading, is managing your psychology and believing in your setups enough to take them time in and time out. Okay? So what are my favorite trading situations with this technique now that we've talked about structure? My favorite trading techniques are to follow the overall trend and scalp it in an overall trend following way, or if the market has gotten away from me. Longer term traders can use it. Like, have you ever sat there, and you guys can give me a yes or a no, because we've had a couple of these days in the last 2 weeks. Have you ever sat there where the market opened up 90 points and before you realized, what was going on, the gap held and the market was up 220 points? I remember, within the last 5 days we had a day like that. And you get caught like a deer in the headlights. You don't want to short the market because all the internals and everything is telling you to go long, but the market can't run forever. And this type of technique can be used to safely step in front of some of those moves and to keep you patient to where your reversals are more likely than a trend continuation. So that's why I like this as well, because it can be used in a variety of ways. And like I said, we got you a little bonus. It can be used to complement other tools and other research. It can be used as a standalone system, but it's better, it's more profitable when combined with other tools and techniques. Okay, you can filter and you can filter out anybody who's ever looked at the parabolic SAR. The other tools, this little method keeps you stepping in for those moves. If you've ever looked at Bollinger Bands, a trade outside the Bollinger Band, you go against that, you counter trend trade it, and revert it back to the mean. Well, not so quick, because sometimes it can stay outside those Bollinger Bands for quite a while. So if you can combine with other techniques, it can be that much more powerful for you. So what I'm going to show you is how I use this, and I use it. I've formed an indicator to show me these things so I don't have to have all this mess on my chart. If I look at this chart, I can barely see price. I mean, you've got price covered up with all these indicators. So if by the time I do my checklist and check off, is the CCI diverging? I don't know. Is the price channel diverging? Is the stochastic, is the RSI diverging? I don't know. There's no way for me to know and check off all these and still make a trading decision, right? So what I've done is I've simplified it, and basically you don't have to have any of the oscillators on your chart. All you have to have is this, what I call the ricochet indicator, and it will show you those divergences. So here we have a trend. I told you we identify the trend, we find the trigger, and we supervise the trade. So my trend definition is another indicator that I use, but anybody can look at this chart and you can say, hey, this is a downtrend, right? Well, here's a bearish divergence on this little price move where one of those indicators, one of those oscillators was showing divergence. And then you can enter the market, you know your stop has to be above here, and then you just ride the wave as long as it lasts. In this case, it lasted about 60 or 70 points. Okay, not bad when you can control your risk to about 15 to 20 points. You can get, like I said, 2, 3, sometimes 4x your risk in the form of your reward. Let's look at a couple of other examples. Here's Thinkorswim. Now, Thinkorswim, the indicator the developer couldn't get the highs and lows to plot like we did in TradeStation. So depending on which platform you use, this indicator may look a little different. But you can see here, you've got an uptrend right here. So the thing that I teach is identify the trend, right? Well, if the trend is going up, we want to ignore the bearish divergence signals, and we want to look for bullish divergence signals. So from this point to this point, it was bullish divergence. It gives you a little bubble window in Thinkorswim, and it takes off for you. Okay, now and like I said, not all of them take off, but you're in an uptrend. You're looking for these bullish divergence signals. This one actually broke structure a little bit and then went up. Okay, you were sideways to, I don't know what you were looking at here, but you got 3 signals at the same place. Can you imagine, and I don't have this one on here, but imagine if you had a Fibonacci retracement to work with right here, or one of Amar's power zones showed up right here, and you get 3 bearish divergence signals. Do you think it would be worth the risk to take the trade to the downside? I think it would. That would be a pretty good trade-off for me, even if I'm wrong. I'm going to risk a little bit in order to make 3 or 4x my risk. So that's what I mean by, hey, use things that will help your trading be successful. And so this is just a look at another charting platform. Here's an example of crude oil. You've got a downtrend. There's no question that this is a downtrend. You're looking for these little red dots, this bearish divergence. Short up here, 56.80 or something like that. Ride it down 55. That's about a $900 move. So 56.80 to 55.90. $900 on one contract. So if you trade 2 contracts, $1,800. I don't know if you can trade that big in crude oil, because crude oil is a very volatile contract. But $1,800 on a day, well, actually in this case it would be in about 10 or 12 minutes. That's a pretty good day's work for me. I would sit around. I'm the type of person that would sit around all day and wait for one of these trades. Okay. So I'm not one that's going to sit here and be in the market every single day of the week. I'm not going to be in the market every single minute of the day. I'm going to wait for a trend to develop. I'm going to look for a retracement in the direction of the trend, find my trigger, and then I'm going to sit back and supervise my trade. I use the Ichimoku. The question was from Gary, do I ever use the Ichimoku cloud? I do use that a lot for my swing trading, yes. I don't use it so much for day trading. I've got techniques that that I believe outperform the cloud on an intraday basis, but for a swing trading basis, yes, I use it quite often. And then this technique can be used with the cloud. While you're coming back to the clouds, you can have these divergence signals trigger either above or below the cloud that would give you certain entries there. Okay. So here's CCI on gold. I've got a 5-minute gold chart here. I've got a downtrend. Here's just simple moving averages or exponential moving averages that have crossed. Gold has made a move. That is one of our criteria. Now it's made a move back in, and now we're looking inside some of these 5-minute bars at a 144 tick bar, and you can see the divergence here. price made a little spike high, the CCI didn't. And then you get your little topping signal, and you know that you can get in a low risk trade that has multiple areas of resistance above it. And so that's using the CCI indicator. Here's the Dow, again, anchor and your trigger chart. Obviously, we're in a downtrend. All the moving averages are in a downtrend. You get a bearish divergence signal on the 144 tick chart right here on the stochastic. Short the market, let it pay you. Okay, really low risk entries on the tops and bottoms. At ATR levels, I'm a big proponent of ATRs. I love the ATRs, and I'll talk about that in what I'm getting ready to offer you here. But if you're at an ATR level, you're more likely to reverse than you are to continue. So you get up here to the ATR levels, we're looking for reversal signals, and you can see you're just playing the range. Here's the upward bounds. You short the market, you play it back down to the lower rounds. This doesn't look like a lot. This is $250 a contract here, about 50 points in the Dow in a very short amount of time, and this is coming out of the lunchtime doldrums. So you know that moves during lunchtime are not likely to continue. They're more likely to reverse. So so the question is, how about the parabolic SAR? I'm not a huge fan. I like that more for the third part of your trading, for management of stops, for supervising the trade. I like parabolic SARs to keep you in and to trail your stop, not for entries. So you'll hear me talk about that when you start talking about the third part of the trade, the supervision. Once you're in this particular move, bring up an SAR, a parabolic SAR, and it will start locking in profits for you. So when you get these little pops up, if you're a shorter term trader, it'll just take you out of the market on a trail stop. So that's one thing I would look for SARs. Here's crude oil market again. You can see a trend change. So right here we had a bottom that was called. I know this is a better bottom, and I'd love to tell you that I would like to take this trade because my signal called it. I think this right here, from a trend following standpoint, is a better trade than this one. If you've got the market falling, this is a dangerous trade. You're going to need some other confluence to make this signal valid. Whereas right here, you've got a clear definition of the market going in an uptrend, and you get a little bullish divergence right here. And I think this part is low-hanging fruit. I think this is the easier trade to manage, the easier trade to enter, as opposed to this one. So that's one thing. You can use this in multiple ways. You can counter trend trade with divergence, or you can trend follow with divergence. It just depends on your risk tolerance. And at certain times, like I said, at ATR levels or something, I may be more apt to take a reversal trade versus a continuation trade. But when we talk about hidden divergence, that's when your continuation trades become really, really powerful. Okay, so I'm running out of time, and I want to leave you guys plenty of time for questions. And like I said, I do have to get out of here right at 5:30 to get to my son's baseball game. I will make you this offer though. If you have any questions or want more details on this, you can use my email address and send me questions, and I will be more than happy to get back with you, probably tonight after my son's baseball game. It's michael@tradethesystem.com. So since I'm going to be cutting off right at 5:30, I will make that offer for you. So here's my offer today. I've got the Ricochet indicator package for TradeStation, Ninja, and Thinkorswim. And if it works with TradeStation, it more than likely works with multi-charts. So you can add multi-charts on here if you're a multi-chart user. I have 5 oscillators that I've coded this for in each of the trading platforms. The CCI oscillator, the RSI, the price channel, the MACD, and the stochastic oscillator. We normally sell them for $97 a piece. I'm actually since I'm doing a different deal, you can actually say I'm giving you all of these for free. The price is $97, but there's something else I'm throwing in with this, and it's going to be the first time I've offered this class. It's called Demystifying Divergence, and it's a course that I'm going to do during live market hours, but I'm going to start the class when there's a lull in the market. So the afternoon, this is going to be the first time I normally do a morning live trading class, and a lot of people get lost. So what I'm going to do is I'm going to break down the divergence, and more importantly, I'm going to show you some techniques for spotting hidden divergence, which is a more powerful concept for trend following, okay? I'm also going to break down the calculations for some of the key levels that I use, like the ATR levels, the 100% and 120% ATR levels, as well as some 2 standard deviation levels that we use. Okay, so I'm going to give you the indicators if you will attend this course. And again, we will dissect the divergence, the regular divergence. I'm going to teach you the hidden divergence, and you're going to get the indicators as a bonus there. The retail value of this comes in at $591. I'm not going to do that. I'm actually going to, since this is the first time we're offering this course, I'm going to do this for 97 bucks and give you the indicator. So it's pretty much the best. That's why we've got www.tradethesystem.com/best, because this is the best offer we've ever done on the Ricochet. We've never offered it in this fashion before. We've offered it in a live trading event. We will trade the closing of the markets on May 28th. We will take you into the close, and if we get like today, if we can use the power zones, we'll use the power zones, and we'll catch, hopefully, 1, 2, 3, maybe even 5 times the amount that this course cost right in this hour-and-a-half afternoon session. But we will give you this course and the indicators for one price of 97 bucks. And that can be found at www.tradethesystem.com/best. In order to give people the attention that I'd like to give them, I'm only going to offer this for 30 spots because the markets will be moving. I'm not going to be able to talk to 100 different people during this time. I want to give you guys, answer every one of your questions. So this offer is only available to the first 30 people. Okay, so that's www.tradethesystem.com/best, BEST, and all of our sales come with an unconditional, no questions asked satisfaction guaranteed. You just email me if you don't think you get $97 worth out of that. I will gladly refund your money. All right, so can someone actually make a living of trading only, or do most people actually make a living training and subscriptions? Good question, Rick. Considering my trading business cost me in 2010 and 11, my trading, the education part of my business actually costed me about $4,000 for the year. So I didn't make a dime off of that. I would say that yes, it's possible to make money trading. It's really how I make my living. The training is basically what I'm doing is I'm building a library for my kids of videos so that when Jackson's finished with baseball, he can actually have something that he can make a living on, and his portfolio will be large enough to where he really won't have to day trade. All he'll have to do is swing trade, selling options. So yes, you can make it. You don't have to do the training. What I find is most people, their first few years, they trade and then they get bored because it is like mechanical work, and so they start offering, to help other people. That's what I found. Does it include the slingshot? It does not include the slingshot. This is just the Ricochet. So the slingshot's a different product. Which platforms does it work on? It works on TradeStation, Thinkorswim, and NinjaTrader, as well as multi-charts. I don't have it coded for Sierra AT yet. We're trying to find a developer that can replicate this code, but for some reason we're having a problem there. Have the indicators, what's the cost? 97 bucks. It's going to be 97 bucks. John, you can email me, support@tradethesystem.com, and we can, or talk to me in the trading room, and we'll see if we can make it worth your while. Is this the divergence indicator? Yes, it's a divergence indicator. Absolutely. It shows you where the divergence is present. I'm a stay-at-home dad trying to make a living from my trading, starting to make money. That's excellent then, Rick. If you're making money consistently, you've already beat about 70% of the people. A lot of people blow at their accounts before they can ever get profitable, and that's why I like to teach, because I like to, number one, I like to caution you to protect your capital. You've got to protect your capital in this game, because if you do blow out, a lot of people don't have the ability to refund their account immediately. So protecting your capital is the most important thing. So I think you're taking the right steps. If you're already starting to see a little consistency, don't worry about how much consistency you're seeing, because the one great thing about trading is we can give ourselves a raise anytime we want to. We just got to show the consistency. Well, John's a member of the trading room, and during slow times in the trading room, we'll start sharing some steak recipes and some potato recipes. So he asked will any recipes be included. John, I have no idea. It depends on how many questions we have. That's great stuff there. That's great. All right. So what other questions do you guys have? Like I said, that's a quick and dirty explanation of how to trade low risk tops and bottoms using the divergence indicator. And you don't have to have the indicator. You can spot that on your chart. It's a little harder. You got to be a little more on your toes. But you can, definitely try this method out, and then if you like it, you can come get more details on it. Do you trade stocks? Occasionally, not very often, Annette. If somebody asks me to evaluate a stock, I will, but there's too many advantages of trading futures to be day trading stocks, in my opinion.